This week on 9th August, we have 3 impactful webinars. By 10 a.m., we have 2 webinars. Master Wealth Milestone, how to turn financial goals into reality, and refunding risk for the Indian HNI, beyond traditional portfolios. Following by 11 a.m., we have NRI Insurance Blueprint, cross-border protection for global Indians. Link given in description. Click the link and join our webinars.
The market has been struggling this year. We have seen a lot of volatility, but overall, it seems like a struggle. The result season clearly tells us that growth and profitability are not going to meet our expectations. In this scenario, a lot of you want to invest money. It is a fact that everybody has got a lot of money to be invested, and the options are very limited. Real estate is extremely expensive and unlikely to deliver decent returns in the near term. Gold has already run up a lot, and chasing it now does not seem to make the best sense. Interest rates are going down. They already are low, and they're further looking like they could go lower. So investing in debt also seems to be unattractive. In this scenario, people are forced to think about investing in equity. It's almost a TINA factor at work. There is no alternative asset. That's the feeling we have. So in this scenario, how do we handle our clients? Because they are coming to us and asking us, can I open an account now? Is it the right time? Unless we make the investor invest in a particular way, there would be no merit in his investing with us. If we are trying to sell him something and collect money, then it may not help him in his investing. For example, if I am going to show past performance today and say that, oh, we did this in 1 year, we did this in 3 years, this is our 5-year record, this is our since inception record, then that may not be so much relevant to him going forward, because we are at a point where investing has to be extremely precise and nuanced. It is not what it used to be 5 years ago. We all know that. Yet, 99% of the investors are still investing based on the past performance. We are seeing it in mutual funds. We are seeing it in the composition of the SIP book of 26,000 crores. Money is going only where people are seeing high past returns. It is not going to a place where the risk is lower. It is not going to a place where the future will be far better than the past. In this scenario, what do we do with our clients? First, we manage money in a way which is always forward-looking and futuristic. Starting from how we set expectations for our clients, we tell them that the past returns may not happen in the next 1 or 2 years. Clearly, we tell them that history is very different. The current economic context does not support the same returns happening in the next 1 year or maybe even in the next 2 years. We even tell them that there could be a volatile phase in the market when your returns could be negative in the short run. We tell them to invest only if they clearly understand these two things. However, we also explain how we invest capital that is coming to us in a market context like the present. We are close to a top. The market has come down at the headline index level. Pockets of the market are becoming cheaper. We are seeing specific stocks slowly coming into our zone of comfort in valuation. So if a client onboards with us now, we would be very, very disciplined and precise in our investing. While we would only invest where we see returns in the long run, we would not be driven by past performance of the stock. We would invest in stocks on their current merits, on our evaluation of what kind of returns we would get if we put money today, and not on how the stock performed for us in the past. So, only if a stock is in our zone of comfort of valuation, we would deploy capital, and as it comes more and more into our zone of comfort, deeper into a zone of comfort, we would keep scaling up positions. So if somebody gives us money today, the first thing they need to understand is we will follow a complete buy-side mindset, where we would buy only on merit and very, very precisely in every investment we make. It would be gradual, incremental and rehearsed. So if you are giving us 50 lakhs in a PMS, all the money won't go the next day. The money would be invested on the merit of individual stocks in our investment universe. As each stock comes into our buy zone, we would deploy capital gradually. When we feel that the stock is completely in our zone of comfort and we can complete our position, we would do that. Once the 50 lakhs is invested, we continue to encourage our investors to make small incremental investments, maybe a 1 lakh or a 2 lakh whenever they can, maybe even a SIP in a PMS. I want every investor to invest the way I invested in stocks, which is regular, habitual and opportunity seeking. So whenever a stock comes down, I try to buy a little more of it. I constantly validate my conviction in every stock in our investment universe after every quarter. And we stay focused on what we do. We don't look at the market. We look at the companies, what is happening in them, how global changes in policy will impact our companies, what kind of change we are seeing in their business environment, whether those changes will affect them in the long run or whether the changes will affect them only temporarily. And these judgments are taken into our decision making, whether to buy or hold or sell. It's completely a buy-side mindset at work in every decision, and it's very disciplined. So what happens is the investor puts in 1 or 2 lakhs every month and keeps scaling up his investments during a phase in the market when sentiment is negative, valuations are trending downward, and individual companies start becoming available at more and more attractive valuations. During the first 6 months of this year, we had a window of time when the markets were weak and we could buy more in many businesses we liked. So we could scale up those companies in that phase. Going forward in the second half, we would definitely have another phase where we would scale up probably in a different set of companies which come into a zone of comfort and which are at very compelling valuations. My sense is that we would be doing this for quite some time to come, and the returns would probably follow. So we are not going to see a phase where stocks run away. We are going to see a phase where stocks are going to test us. And during this phase, we would remain steadfast, focused on keeping our conviction strong, growing, and turning that conviction into little incremental decisions in every portfolio, which will deliver superior investment returns over the longer time horizon. So there's a lot of work to be done. From our side, there's a lot of work to be done. Running a portfolio aggressively with a buy-side mindset in a bad market is what will give superior returns when that bad phase in the market ends. I definitely look forward to the times when stocks becoming weaker throw more opportunities at us, put our portfolios under some temporary stress, make it very difficult to generate short-term returns, and keep us on our toes to find newer opportunities, to scale up existing opportunities, to grow conviction in what we already own, to be very precise in our sell decisions, and to ensure that our portfolios are always becoming stronger with every crisis and positioning themselves very precisely for the future. That's what a buy-side mindset does to our investing, and I hope it does the same to your investing. Thank you for watching this video.